Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Yeah, it works good. Can you see this okay, or I'd better... Is this all right? Can you see this all right, or I'd better turn off some lights? Turn off some, okay. I'll see how can I manage. Is it better now? Yeah, I think yes. All right. I know many of you have exams either today or this week some days, right? I understand. Basically, as just what you have learned from your prerequisite course. So hopefully this doesn't give you more burden. All right, let's hope so. And I'll try to finish on time. Yeah, or if couldn't be earlier. All right, I'll try to save a couple of minutes for you. Let's see. All right, before I start, have you noticed my post on Walto? I think I'd better not address that every time, but this information is important, so I hope you do observe that. So first of all, I updated the extra consultation hours during the break. So if you got any problem, try to come to see us face to face. Because I received a couple of emails from a couple of you. The problem is the question you asked normally involve a couple of steps to explain. And if I don't know your understanding of the first step, it's very hard for me to explain you for the following ones. So the best way is always come to see us and make the best use of us, because we try to make ourselves available for enough time so you can try to see us. And you will probably notice most of the students will come to at the last minute, right before the exam. Please try to avoid that rush hours, because during that rush hour, there is traffic jam. You probably can't get through. Okay, last year I was kind of, immersed around all the students, or over 10 maybe, and some of them queuing outside of my office. Then my colleague from the school office even came to ask me, "Are you okay?" So please try to avoid that peak time, all right? So don't accumulate all your problems until the last minute. There are some tutorial swaps due to the public holiday and some clashes with the mid-semester exam. Let me quickly show you. Can I see my post? Okay, I may. Okay, anyway, I'm not trying to use the time to find out the post, but you absolutely can see that from your Walto announcement. I just added 2 topics. The facts. Oh, sorry, I didn't mean to scare you. All right, so for the future assessable amount, future deductible amount, many of you couldn't get it right. So I uploaded one new explanation, got some additional explanation. Make sure you do check that. Even though you understand, you feel like you understand everything, still check that to check your understanding if that's correct, all right? So I uploaded one post. So you can see from that to understand the future assessable amount, future deductible amount. All right? That's the key to get your deferred tax asset, deferred tax liability correct. All right, make sure you check. Another post is about the swap tutorials. So if you, not regarding this week's tutorials, that's regarding the week 7, which is after break, okay? Week 7's tutorials, if you are in Thursday groups, you will be affected. All right, Thursday group students all will be affected because Thursday is going to be a public holiday. That's the Anzac Day. So some of you can attend some other tutorials. I posted how can you attend the other ones. And yeah, we also have 2 makeup tutorials on the week after Monday. Is that clear? So if you have tutorial on Thursday, because we have 6 groups, so almost half of you will be affected. So your tutorial will be on the week after, and also on the week after Monday, or some of you swap to Wednesday evening. All right, and for the students who has the tutorial on Wednesday, so 3 o'clock, that will be too challenging for you to come because you haven't just came out your exam site. So that tutorial, you can just go to the 2 following ones. 3 to 4 ones, you can go to 4 to 5 or 5 to 6. All right, is that clear? So you don't need, you can have a little bit fresh air after your exam. I can imagine sitting in a dark hall like this after 2.5 hours, then you rush into another one without a breath. Then, yeah, most of students will be late and we can't finish that tutorial. So that tutorial has been moved to the following 2 ones. All right, so is that clear? Then you check the details on the wall. Additional information on the future assessable amount, future deductible amount. Hopefully, you will get there. All right, it will be fun. Today's lecture, we cover 2 chapters. One is about the share capital and reserves. Another one is provision and contingent liability. So basically what we have learned is most of them about assets, right? We talk about the impairment revaluation, and now we talk about the equity, which is chapter 13, and we talk about provisions and contingent liability. This is about liability, chapter 8. We don't talk about the fundamental, the most basic knowledge on equity or liability. What we cover here are some advanced issues. So share capital, we don't just have the day we issue, we got them. Now we got the share capital, more about the rights issue, the option issue. So that's not the common share, right? The rights issue, the option issue, the bonus issue, and the conversion of the shares. And also, sometimes when we want to issue shares, we may just want to issue 1 million, but we sometimes got 1.2 million subscription. So there is cases we got over subscription or under subscription. How do we deal with those issues? All right. So that's more advanced issues for the share issues. Then we also have the for the equity, this basically is what we are covering. And for the liability and contingent liability and provision, we learned liability, right, in your prerequisite course. And now we learn something slightly different from what you have learned, okay? And we will not spend a lot of time on that. Basically, I just ask you to know how to identify them. Provision or contingent liability. And if we have provision, you have the recognition. If you have contingent liability, how do we deal with them? You learned a little bit. At least you heard it a little bit, right? Contingent liability, do we recognize them? No. What shall we do? In the note, disclose in the notes. We kind of can recollect our memory from the close them in notes, we don't recognize them because they don't meet the recognition criteria for liability. Okay, so we are going to discuss that in the second half of this lecture. All right, so first of all, let's start with the equity. We have some very basic, I guess, let's just quickly get your memory back from what you have learned in your prerequisite course. Then we are going to discuss the issues of the share issues, like the option, like the rights, like the conversion. We'll do that, all right? Before that, I'll briefly lead you through the whole thing so that you don't feel everything is coming, sharply to your mind. You may forget something, all right? So basically, the equity you learned, right, differs when you have the sole proprietorship or partnership or company. If you are sole proprietorship, you are the single owner. There is no need to differentiate the the capital invested and your profits, right? That's easy. And if that's the partnership, then we will have more than one owner. Then this equity will be used to distinguish the capital invested and the profit you earned from the business. All right. If that's a company, we're going to have multiple owners. If you have multiple owners, the formation governed by the legislation will require distinction between contributed equity and other types of equity. So what we learn, we are doing here, we are doing corporation accounting. So we don't care the sole proprietorship or partnership. We are dealing with the company when they have the equity, okay? Equity, we can have different equity accounts, right? We are going to discuss that as well. And the shares normally in company will represent the company's ownership, and this ownership is normally transferable. Remember that we have the initial public offering, so that's the initial market. Then we have the secondary market. So if you are not happy with this, we vote by feet. Okay, so we just sell it, then we go. Okay, so that's the transferable ownership. The rights of all shareholders include voting rights, always the first thing you have. So basically, one share, one vote. All right, every share has equal voting rights. So that's the first thing. And if in the case of the vending or liquidation, you are entitled like the debt holder. After you distribute all of their shares, if there are something remained, you are entitled to share that remained part. Okay, that's the rights to share in assets. And the rights to share in new share issues. So when the company issues some new shares, normally the existing shareholder will have the priority to get the rights. Why? Dilution, right? If I'm currently holding the company and I have 10% of this pie, but now you are enlarging the pie, you issue new shares, right? You enlarge the pie, and I'm still holding the 10% of the previous smaller pie, then my rights will be diluted. So you always need to entitle the existing shareholders for the new rights issue. Okay? And shareholders have limited liability. Limited to what? Yes, limited to what they invested, right? The shares they invested, the capital they invest. And that's not just subject to the partially paid, also the nominal value of the shares. That's what we have covered in the first or second lecture. All right, so that's it. And the ordinary share would be the most common form of shares. The most common form of shares. There are another types of share called preference shares. Preference shares, they kind of share some similar characteristics with the debt, the debenture. They have, based on the terms and the conditions, they might be classified into different categories. So like the cumulative or non-cumulative. When we talk about cumulative, non-cumulative, what are we talking about? Do you have an idea? Regarding to their dividends. So if, let's say, because preferred shares, for all the shareholders, we are not obligated to pay shareholder dividends. It's different from debenture or any bond. If that's the bond, you have to pay the interest. If you can't pay the interest, you probably will get sued. Then you go bankruptcy, liquidation, right? However, preference shares, because normally you have the term say, okay, I'm going to pay you dividend 10% every year. If your nominal value is $1, so I'm going to pay you 10 cents every year. But you're not obligated to pay, right? So that's why we have two types of preference share. One is called cumulative, one is called non-cumulative. If current year, the company simply doesn't have that money to pay you that dividends, either they accumulate this dividend to next period until they have that money, or you give up. Okay, so by this we have cumulative or non-cumulative. All right, okay, and participating, non-participating in what? Management, not. Management, the shareholder normally don't directly participate in managing the company. What they do, they vote, they elect some directors, okay? And directors will appoint the managers, so that's about corporate governance, right? Participating, not participating in dividends. Okay, common shares dividend. Okay, so if I'm the preference shares holder, and I have my share, which is subscribed in the, which is described in the terms and condition. All right, and I get my preference share dividend. Okay, but if I'm still entitled to the common share dividends distribution, that will be called participating, otherwise non-participating. Okay, so this is another category. Convertible, non-convertible, to what? Debt. You absolutely learned the convertible debt, right? Debenture, did you? This convertible, non-convertible means to common share. Okay, so if you convert that to common share or not. All right, so that's regarding these preference shares. Oh, this one is just repeating. Redeemable, non-redeemable. Okay, so normally we know shares are not redeemable. So once you invest, it will be there all the time. If you really want to get your initial investment back, sell it. Okay, but you can't get it back from the company. You can't claim from the company. Okay, but their share after a certain time, they can get their initial investment back. So then we have the redeemable or non-redeemable. Okay, so that's just some basic knowledge of the preference shares. The company can issue shares on any terms or conditions it determines, and the share capital may include ordinary preference like we discussed. The preference share should, if they are about to issue preference shares, they need to have a constitution to set out the rights to issue those shares. Okay, so that's about the preference shares. And any share can be issued in full or partially paid. Right? We have learned this briefly, right? It could be paid full or partially. Yeah, so there are some procedure you need to follow from the Corporation Act. And a share issue normally will be accompanied by the disclosure document. That's normally it's just called prospectus, right? So you need to have this disclosure document. If you are interested to see how it looks like, you can just click. Then there is a link. You can see how it looks like. And this one need to set a couple of things, and at least it will set the minimum subscription. What is the minimum subscription? Like, if you are about to issue 1 million shares, and only, let's say, when you get 60%, that is the minimum subscription. If 60% successfully issued, then that is a successful fundraising, the capital raising. Otherwise, you just have to return everything you have raised. So that is about the minimum subscription. And this minimum subscription needs to be achieved within 4 months of the issue of the disclosure document. Once you start to raise money, and within 4 months, you need to meet this minimum subscription. Otherwise, you just got a failed one. Okay, that will be unsuccessful. So when we have this prospectus on the market, so people start to think about this subscription, right? They want to buy a share or not. And when during the invitation period, do we do any accounting journals? Accounting, right? So here is some shares. You can have a look. It looks like this, all right? So yeah, just the certificate of the share, the holding rights. Okay, because we have the partially paid and full paid. Full paid would be relatively easy, right? So once you get money, cash in, share capital increase. That's normally what you have learned, I guess, in your prerequisite course, right? But now when we have partially paid, that would be a couple of steps. And for those steps, each step, how do we do accounting journals for that? That's the topic we are having here. So if they have this installment basis, we will have different accounting, and you may see some new terms, some new accounts. Like in previously, we just have cash at bank. Now we need to have the cash trust, right? That's the new account, I guess. Yes, because if that's the trust account, that's not your money yet until you can confirm. So during the application process, so a normal procedure for a share issuance, they start for invitation and people start to think about it. Then you open for the application, money in, right? Then you have some account, you will call them application. Okay, then the control account would be cash at trust, because at this point of time, that money doesn't belong to you. Okay, so at that stage, we will have application and cash trust. That will be the first step. Then you will decide how do we allocate those shares to the person who subscribes them. All right, so then the issue we would have is oversubscription or undersubscription. If people ordered, like I have 1 million to issue, the original intention shows, the application shows 1.2 million. How do we do that, right? Do we prorata allocation, or we just have first come, first serve? All right, you need to specify those terms, conditions in your prospectus. All right, and then later on, we will have we will have share issues. If we have decided how to allocate the shares, then we started to recognize, we close the application to share capital. So that will be my real share capital, right? And if you determine how they pay for the following installments, you may have an account called call. Okay, call money. That is, you decided when do you collect the rest of the money. You will have the account name called call. Okay, those are the new accounts name we have. That's very simple. You just need to memorize a little bit. So this topic is not challenging at all, but you do need to know how to use the new account names. All right, how to determine the amount of them. That's it. So this topic is quite straightforward. Yeah, but you need to pay attention to the details as well. Accounting involves a lot of details, right? Oh, that's why we become smarter. If you look at accountants, the lifespan for accountants normally will be longer because we use our brain all the time. We may also become smarter. Okay, so for when we are issuing the shares, there are two ways to get the stock placed. The shares placed. One is the private placement, one is the public offering. For the private placement, now let me see if I have slides for that. Okay, it's all here. So we have private placement to the public, or we will have the issues to the public offering. If that's partially paid via a private placement is simple. Like I will discuss with several funds. I'll discuss with the fund managers or some other institutions or some really big, really rich people, millionaires. So I decided to issue shares to them. That will be the private placement. So for private placement, you can save one step because you may have the application process, but you don't need to really allocate how much they have because everything is negotiated, right? So that will be relatively simple. What we discuss here is about the public offering because when it involves public offering, there are uncertainties involved. Right, so we don't know how many shares we can issue and how many of them we can allocate. So this involves more uncertainty. Then here we would have the cash trust. For private placement, we wouldn't have the cash trust because when they start to pay money in, that's negotiated, that's settled. So you don't need to transit. You don't need to have this transit account. Okay. Transfer to cash at the bank, and the application will eventually close to share capital. Okay. Okay, so normally when the share is issued, when the share is issued, and we only have partially paid, right? We only have partially paid, then let's see if the share $1 and the first at application date you paid 20 cents, and I decided 4 months later I'm going to receive another 30 cents, and that's determined. So in 3 months I'm going to receive that. What is that? The specific name is called allotment or call. If that's the first allocation, that would be called allotment. Allotment, you may just pay the one for the first installment you haven't paid through application. Is that clear? I will say that again. So let's say if on the first installment for the share, once I decided how to allocate the share, how to allocate the shares, I may say the first installment is 20 cents. But during the application, you only pay 10 cents. Okay? Now I decided how do I allocate the shares, how much share you will get. then you will pay another 10 cents. But that's still just close your application, right? So that one, when I'm deciding you need to pay the following 10 cents, that's during the application process is called allotment. So, allotment. So that allotment account would be just the balance due on issue. So on the day issue, you need to pay 20 cents to guarantee the share I can issue to you. But in application, you probably paid a little bit, not because you don't really ask them to pay the full first installment, right? So on the day of the issue date, you pay that is called allotment, except for the application money, that will be the first allotment. Then on that day, I'm deciding allocating the shares to you. I may also decide when is your second installment day. I decide that day. If I can decide specify that date, I will also record one thing called call. That will be the second installment or the following installment that is called call. Okay, the call money. So because when you recognize it's a call, your share capital also increased, right? So the shareholders are obligated to pay the full amount. But this one specify the days, then you have specific account called call. Okay, in nature, what is this allotment and call money? Call money, let's say, just say call. What is the nature of this call? Is that assets, liability, or equity? What do you think? When I'm allocating the shares, I decide, okay, you can have some share, you can have some share. All right, and I receive the first application allotment money. Then I decided 3 months later you'll pay the call. And I recognize call and share capital. So the call, is that, what is that? Is that account receivable? Yes, it is account receivable, right? But we give them name called call. And account receivable is really in nature, that is the asset, right? In nature, it's assets. However, when you prepare for the financial statements, we don't disclose it in the assets part. The reason we don't, but in nature, it's assets, right? Your account receivable, your receivable, right? But we disclose them in the equity part because it's really closely associated with the equity. It really shows what equity you have. All right. So we disclose it in the segment of equity. All right. But we use the offset account because normally when we increase equity, do we debit or credit? We credit the equity, right? We credit the equity. But now, because this hasn't got that equity, so we use the debit side equity. Okay? So you can see that is deducted from the equity. When you are preparing for the financial statement, you can see that becomes the deduction of the equity. All right? Okay. Okay, so we don't do that until we can specify a future date. So here is the brief summary of the partially paid shares. So first, during application, during invitation, we do nothing. And during application, we start to recognize because money in, right? Then we create 2 transit accounts. One is cash trust, one is application. Okay, then when we can decide how do we allocate the share, because you apply for the share doesn't mean you will get a share. All right, so when we start to allocate the shares, we can close the application to share capital. All right, then when we can decide how do we allocate, we will have the share issue date remained money, we call them allotment. All right, so when we decide, when we can recognize the successful issue of shares, we will close application to share capital, close cash trust to cash and bank, and we can decide how much shares to be allocated to the successful applicants. All right, and then we issue the first call if we can decide when we have the first call. All right, so then we will, because during the day this allotment money will be the remain, associated with the application, that will be the issuer date money you will receive. All right, so then we will generate this call because we can specify which day to have the first installment. Then we generate this call and the share capital will be increased accordingly. All right, then when we receive the allotment money, we close this to cash at bank. The share capital has been recognized in a stage when we can decide how do we issue, do we allocate, and when do we start the first installment, right? So this one you just close it when you get the money. You don't need to recognize share capital again because you have recognized as the first step. All right, then we have the cash at bank when you recognize the receipt of all the call money. Okay. Oh yeah, this is about the private placement. So private placement, you just save the first step. Can you see that? The application cash trust and application closed, we save those steps. Subscription. When you have oversubscription, how shall we deal with that? There are two approaches. One is to satisfy all the demand of a certain number of subscribers, just like first come, first serve, maybe, or some other criteria, okay? But this might be unfair to somebody else because you said my open for application is for 15 days, but you only grant the shares to the first day's subscribers. That's just unfair, right? So they may have another approach, which is the issue share to all the subscribers based on a pro rata, right? So they may proportionally allocate the share to all the subscribers. So that's the second approach. If that's the first approach, you may have to refund the funds advanced by all the other unsuccessful applicants. All right, you need to give their money back if you don't want to give them shares. In the second one, if you have this share to all subscribers, you also have excess money. Do we understand that? Because we 10 of us subscribe the shares, but they allocate to all of us, right? But actually they only want to, 80% of all of our subscription can be issued because that is what they demand, right? And we got oversubscription. Then every one of us, because they only proportionally allocate to that 80%, so every one of us can only get 80% of what we have subscribed. Then 20% of that application should be refunded, right? They can have two ways. Either use that to refund us, or they just keep that excess money because they will soon decide the allotment, then use that application to offset that allotment. Because you're still obligated to pay for the following if you want to get the share, right? The following installment. So you can use that to offset your following payment for the shares. Is it okay? All right, let's have a look at the example. In July 2012, Mululaba calls for public subscription for 10 million shares. And the issue price per share is $1.2 and 50 cents on application, 40 cents within a month of allotment, and 30 cents on call. By the end of July, applications have receive. Okay, so yes, when we are open for invitation, we don't do anything, right? And from the 1st July, in 1 month time, they receive money, right? So during the time, whenever you receive money, we will have cash trust and application, right? This is cash trust application. Okay? Do we have any problems with that? So when you open for this, people start to put money in, then you get application and cash trust increase, the two transit accounts we created. Okay? And then we assume the X, because actually application, if, do you know where do we get the 6 million? 12 million times, because we got the real subscription, 12 million. We got the real summation, 12 million. And during application, it should be 50 cents. All right, so 12 million times 50 cents, we get 6 million. Okay, however, if we just got the proper subscription, just the amount I want to issue, how much I should get? Just 5 million, because I only want to issue 10 million, right? 10 million times 50 cents will have 5 million to be issued. Okay, so the actual amount should be 5 million, but we do receive 6 million, right? So we got oversubscribed by 1 million, right? 1 million. We will assume that excess money can be used to offset amount due on allotment. How much on allotment? 40 cents, right? Within 1 month of allotment. And 30 on call, then this will be fully paid. Okay, so 40 cents within a month. So then, first of all, I receive application. Then I got the excess subscription. Then I will decide how to allocate. Okay, I decide to allocate pro rata base. Okay, on a pro rata base. Then basically everybody only get how much? We don't care how much they actually, each individual of us, because in the company's account, they only see the total number, all right? They don't really need to do that records for each of us. They will just just get the total amount what we have, all right? So the application actually should be just 5. We use it to offset the allotment, right? We use it to offset the allotment. So now, when we can decide how much to allocate the shareholders, we would also determine the allotment to recognize the share capital. Then the first issuance finished. Okay? So now I will have the allotment because the call has also been decided on the day, so we can also recognize the call. Then we recognize the share capital. All right, so we recognize the share capital because how much we want to raise is 1 million, right? We only want to raise 1 million, and the allotment is 40 cents, and the call is 30 cents. So this is the amount of money for allotment, this is the amount of money for call, and in total, we can see the share capital. 7 million, 5 million, that's just the total amount. If you look at here, the share price 1.2 and 10 million share, I will just have the 12 million share capital. And now, once I can decide how to allocate, then the application 5 million, the allotment 4 million, the call 3 million. In total, I will have 12 million. So the share capital all raised, right? And then I will start to receive money, right? Once I can recognize the amount that I recorded in accounting journal, and then I will start to receive money. And for the application 1 million, we use it to offset allotment. So all of us who oversubscribed, who paid more money, don't need to pay the full allotment money, because our application access money will cover part of that. And what we pay is just the part that our application didn't cover yet. Okay, so how much we need to pay? Remember previously we recorded the allotment is 4 million, right? Sorry, here should be 10 million, right? Yeah. Okay, we have 4 million, which means if there is no oversubscription, another 1 million was there to cover the allotment. Okay, so we use application to offset the allotment, and you only need to pay 3 millions for the allotment, right? We only pay 3 million, right, for the allotment. Is that okay? And on the 1st of August, because that day you decide, you decide how do you allocate the shares, we also can transfer cash at bank to cash trust. Sorry, transfer cash trust to cash at bank. Okay? Are we okay? Then later on, what happened? What happened next? We receive cash for the call money, right? So when we receive cash, how much call we recorded? How much? 3 million, right? So 3 million call got paid, we got cash in. Okay? So now the whole shares issue finished once you finish receiving all the cash. Is that okay? Any question? All right. Then we have, yes, sometimes we got over, sometimes we got under, and sometimes when we got successful allocation of the shares, we may decide to forfeit the shares. The reason could be multiple. Yeah, like the person who subscribed the share dead, right? That's possible, that happens. And maybe that person still alive but got bankruptcy. All right, don't have enough money to pay the following ones. Or that person just changed their idea. They don't want to keep investing at all. All right, so if that's the case, we will get the forfeited shares. When we get forfeited shares, how shall we deal with that? So we may have two ways to deal with the forfeited shares. So we may return all the money we have received to the original shareholder. We may return that, or we may keep them, because that's your obligation. That's what you give up, right? So you may have two ways to deal with that. One is called forfeit share reserve. Another is called forfeit share liability. So for the reserve one, what we do? What we do so that we can get the reserve? What we do so that we have a liability? If we decide to keep them, do we have a liability or reserve? So if some shareholders decide to forfeit the share, they give up, then, but they have paid money, right? If we decide to keep them, is that a reserve or liability? Reserve. You got some extra money from somebody else, right? And that shouldn't be contributed as the equity because they don't count as equity, right? So that will be reserve. And if I decide to give money back to them, I need to give them back. I'm obligated to pay back. That will be your liability. Okay, so this way we have two accounts. So I'll show you how do we do them. All right. So the first example, they issue a call on 10,000. So first step, they apply, then they got allotment. So the first issuance done, right? Then I also specify a call money for the following installments. And the call money should be 10,000 shares, and each nominal value is 2. So if they have paid $1, so I should have 10,000 call money. Does that make sense? So they have paid $1, so my call money should be $1 times 10,000 shares. All right, for the following installment. Okay, once we have that, we must, when we decide which day we collect this installment, we must have recognized this. Do we agree? Because I have recognized the call, this must have been in my account, okay, in my accounting book. So I have recognized call and share capital. And now I'm receiving the money for this call. If I do receive all the money, I would just close this call, then recognize cash, right, for the full amount. Is that okay? However, I didn't. I only received 8,000. $2,000, right? Okay, so they forfeited the share. When they forfeited the share, if we decide we return this share to the original shareholder, like I mentioned, we will have a liability, which is just the forfeited share liability, right? So if we decide to return the money to shareholder, we just record the forfeited share with the unpaid call money. So this 2,000, we don't receive, right? We don't receive. But they need to be closed because they are not going to be received, right? However, when you close this call, you didn't receive cash, right? But previously, you did recognize share capital increased by the 2,000. Do we agree? Yes. So for this call, we need to offset 2,000 of the share capital. 2,000 of share capital. Is that okay? Because when I record the call, I did record share capital. I'll assume my share capital will be increased. However, it wasn't. So I need to cancel that increment. Is that okay? So that should be 2,000. But why I have 4,000 canceled? I'm right by putting 4,000 over there. Why? Where does that 2,000 come from? Refund, very good, for what you have received. Remember, those shareholders who forfeited share, they don't just give up the call money, they also give up what they have paid at application or the allotment. Remember that? Yes. So this is $2 share. They only $1 remained, means they paid $1, right? $1 times the 10,000, then they have, no, $1 and the forfeited ones are 2,000 shares, right? Is that okay? 2,000 shares they forfeited. So 2,000 times $1 they have paid. They are obligated to pay this call, but they didn't pay. So call offset what have been recognized as share capital. And what they have paid, $1 previously, that's also recognized as share capital, right? So we should decrease the share capital accordingly and recognize okay, so record liability, and that's the forfeited shares. And if there is nothing else happened, what is the next step? If there is nothing else happened, what shall we do next? Just distribute the money back to them. So we should have cash out, liability, offset. Okay? If there is nothing else happened, we just simply get rid of the liability, pay the money back, done. All right? However, they may also do something because they want to raise that much money, right? They want the share capital to be that amount. So they may issue these 2,000 shares to some other shareholders so that they can keep the whole share capital as what they want. Okay? So now they may issue to somebody else. Yes, but they may issue them by a discount. Okay, originally that's $2 per share. Now they may say, okay, I'll give you a discount, 1.5. All right, so they may issue it to somebody else. If they issue them to somebody else and they ask for 1.5, so for 2,000 shares, that's 3,000 cash in, right? 3,000 cash in and share capital, they still recognize as 4,000, but that would be 1,000 discount, right? That 1,000 discount, they say, okay, because you are the original shareholder, you are obligated to pay, and you didn't, then I have to give discount, so you have to bear the cost. Okay, so they decrease the liability by that discount. Is that okay? So then the liability will be decreased by 1,000. Then they start to return the money. If there is anything, when you are returning the money, you may have to find a way to distribute the cash back to them, right? If there is any transaction cost associated with that, the original shareholder have to bear that. Okay, so if there is any cost associated with the distributing money, so they will also decrease the liability and cash out. So now how much liability remained? Originally, the liability is 2,000, right? Liability 2,000, and they use this for discount, so 1,000 left. Then they use this liability gone. All right, so this is when you have the liability return. And if you are about to keep the money, you don't want to return to them, then we do exactly the same for the first step. Call money 2,000 you didn't receive, so we should have 2,000 for this call. And for the money you received at the first step, that's another 2,000. You transfer that to your reserve, okay? You transfer to your reserve. And if you are about to issue the new shares, if you issue the new shares again on discount, then you also have the cash in and the share capital increase, and any discount should be offset that reserve, because then you don't have that much reserve, right? And later, if you have any other costs associated with the payment, associated with the new sale of shares, then you keep decreasing that reserve. If there is no such thing, that's okay, that's done. Okay, if there's no such thing, that's done. If there is such thing, you need to recognize. Okay, so that's it for the forfeited shares. Okay. Okay, let's have a look. See, yeah, let's have a quickly look. See how do we get the quiz done? This one. Can you send your, yeah. If the balance in the forfeited shares account is refundable to the owner of those shares, the forfeited share account is classified as what? If you need to return something to somebody, refund, then you will get liability. Very good. So that will be the liability. Okay. Excuse me. When you hire an underwriter, okay? When you hire an underwriter, why do you want to pay somebody to get this to get? Why do you want to pay them to get your share underwritten? Because normally when you have the underwriter will have some agreement. You have some agreement, they will purchase all the excess share where you can't sell them out. So you can keep the money exactly as how much you want to raise, right? So that's why you may have the underwriting cost. Do you think this underwriting, suppose you pay, let's say, $30,000 to get your share issuance underwritten so that you can raise the exact amount of money that you want to raise? How do you think about this underwriting cost? Do you think that's the part of your equity deduction or that's just part of the cost? Expense. Shall we expense them or shall we capitalize them? We do understand the capitalize and expense, right? If we capitalize, which means you are benefiting for the next following period, not only for current period. If we expense, we believe they just for current period, right? So what is that? We will just treat it as reduction against contributed equity because your equity is going to be, you benefit from this fund raising, money raising, right, for all the operation. So we capitalize them, which means we use it as a reduction against your contributed equity. And if you have other share issue costs, like the stamp duty, legal fees, what shall we do? We still capitalize them, reduction against the contributed equity, right? However, when the firm has formation cost, that is not related to your public issuance, not relating to their share offering. But mining company, when they are issuing shares, that might be the first time when they are formed, right? So when they are formed, they may have the formation cost. That cost you can't capitalize to your equity because that's not related to the contributed equity. That's regarding to your formation cost. That one you just expense it. You don't shown on the statement of financial position is just normally look at this. look like this. The share capital less the call in arrear. If you have some paid in advanced costs, you add them, and less the underwriting commission, less share issuing cost. We just discussed these two, and then you will have the total share capital. Okay, for rights issue. Rights issue normally just provide existing shareholders with the right to acquire additional shares at a very attractive price. All the existing shareholder will get this right, and some rights might be renounceable, which means they can trade it. Some are not. So if you don't utilize that right, you give up. That's just a waste. Okay, so then you will have renounceable and non-renounceable. And for the option, that option gives the holder the right to acquire shares in the future at a particular price. Normally, this option will be given to the employee. You probably hear a lot about the stock option, right? So like the top executive, they always get the option, so they can link their compensation closely to the stock price. So normally they will give you stock option. You have learned a little bit about corporate finance, right? So if you have the option, they may specify, okay, in 1 year's time, you can, suppose current stock price is $2, and they may just randomly came up some cases. They may say, okay, after 1 year, you can exercise the option, and the exercise price is $2, which means you can use $2 to buy a share, maybe for 1,000, 2,000, 10,000 shares, 1 year's time. But you might be wondering, the current price is $2, and I need to pay $2. Why do I bother, right? I just got nothing. But the incentive here is, this incentive scheme really incentivizes you to drive the price as high as possible. If you work very hard to get the stock really good, to get the company really good, the share price is supposed to be increased. It might be $2.5. Always have some locked period. During that period, you can't exercise, but from a long-term view, you will benefit, because we suppose you work very hard, then the stock price will go high. Okay, so that's the option. Option doesn't specify when do you sell the shares, but they will specify when you can buy the shares. Okay, that's about the purchasing option. All right. I'll give you an example for the rights issue. So a company announced a renounceable 145 rights, and the term and condition of the issue asks for 50 cents to be paid if the shareholder is exercising the right. So this right isn't free. You need to pay 50 cents to get this stock, right? First of all, do you understand 145? When you see terms like this, which means every 5 shares can get 1 new share, 145. If that's 144, that means every 4 share can get a new share. Okay, so that's the terms for the rights issue. And they ask for 50 cents to be paid if shareholder is exercising the right. The market price for the share is $1 at the time of exercising the rights. And 200,000 shares exercise their rights, which means how much they paid, how much cash the company received. $200 shares exercise the rights,
and every 5 shares can buy 1 new share. How many shares? 40, right? 40,000 shares has exercised, right? So 40,000 shares are issued. How much money received? $40,000 and $5.50 every share. So that would be 20, right? 20,000. So the company will receive 20,000. Okay. Then what should be the control account? Share capital. Right. Have a look. Okay. Example. Next example. So yes, this example is regarding option. So the amount received for option, let me see, 50 cents per option and 100 options to buy share. Okay, so the option has a price. Normally, if the option is only to the employee, like I mentioned, that will be given, granted to the employee, to the executives, or ordinary employee could possibly also get some option. Now they have a lot of employee option plans, so basically just to incentivize them to work harder. Okay, so if that's given, then that will not be recognized as the share capital because that's given, right? You don't receive money for that option. Okay, but if the option is sold, so basically, if you really think my company has a better future, then you may want to put a price for getting a right. This is called option. And in future days, you can buy the share at a particular price. Okay, so that is also the option can have a price. All right. In that case, this option is 50 cents. The option price is 50 cents, and this option entitles you to buy the shares for $1 per share. Okay, is this clear? So how do we record them? When we have option, yes. So 100,000 option issued. So we will recognize 50,000 cash in and option increased. We won't have the option eventually. This option just a transit account, which is going to be closed. What do you think it will be closed to? So this option is also a transit account. It will be eventually closed. Which account do you think it might be closed to? Share capital. Okay, share capital. So eventually it will be closed. Okay, so in this case, first of all, we issue all the option. However, you purchase the option, but when you want to exercise this option, you may decide to exercise or not to exercise. There are multiple reasons. You might be just short of money. You don't want to exercise. And if you exercise, you may just lose money. So you may want only 80,000 option exercised. How much give up? 100 less 80. 20 option give up. All right. So this one, you will never return to them because you sold something to them, right? So we don't give them back. If we don't give them back for the options they didn't exercise, what do you think we should record? We will just record them as an equity account, which is reserve. Okay, we'll just record them as reserve. All right. So now we have share options. Only 80,000 exercised, and that 80,000 only counted. Think here, we have 10,000. We have 100,000 times 50 cents. Then we get 50,000 option, right? But now only 80,000. If we have 80,000 times 50 cents, we only have 40 option exercised. So we offset this option, 40,000, to this share capital. Okay, so among them, 40,000 is the share option. Okay, we transfer the exercised option to share capital. That's 40,000. And at the meantime, we receive money. Do we agree? You could have this as two separate ones. The first one, we have share option close to share capital because only 40,000, only 80,000 exercised, and each option is 50 cents, so I've offset the 40,000 option. Close 40,000 option to share capital. Okay? And another journal entry, I do receive cash because 80,000 option exercise, which means $1 per share, they have 80,000 purchased, right? So I have 80,000 purchased times $1 per share, we get 80,000 in. 80,000 in share capital increased by 80,000. Is that okay? All right. You could have them separately, or you could have them combined here. All right, that's okay. Both way are okay. How about the one if only offset 40,000? What about the 10,000? To close them to reserve. We just call them the lapsed option reserve. Are we okay? Make sense? Good. All right. Oh no, I don't want this. I want this. Yes, good. Have a look at this. The option is just an instrument that gives the holder the right, but not the obligation to buy a certain number of shares in a company by a specified date at a stated price. Sell a certain number of shares in a company by a specified date at a stated price. Receive a certain dividend declared by the company. Receive a bonus share in a proportion as notified by the company. So the answer is A, is a right to buy purchase option. Okay, so that's the option. Okay, another one, company can get another way to get their share capital increased, which is the bonus share. You know, sometimes the company may have enough money to pay to the shareholder. They have enough cash flows. They may want to pay them dividend, but sometimes they may reward them differently. They may have some dividend. They may have, if they produce some product, sometimes they just send product to original shareholder. It happened. Okay, sometimes they can also issue some bonus share. When they issue bonus share, they probably have a big amount of reserve in their account. Then they say, okay, I will treat this as the contributed capital. So they will transfer the reserve to the share capital. So basically the shareholder shares increase and the contributed equity increase, but the reserve will be reduced. Okay, so in this case, basically the pie is still the same size, but you just reslice it. Okay, some part of them, the contributed capital will be increased, and the reserve must be decreased, right? So basically, just reslice, reallocate the shares. Basically, you would think nothing changed to the company, actually, right? No more money in. all the time responded positively. So the share price increased. Basically, nothing happened to the company, but the share price increased. One reason is people believe this would be a positive signal for the company because they don't need that reserve for any other reason. They just want to give it back to you. So they have enough reserve. That's a positive sign normally. So yeah, somebody who would like to do research, because nothing changed, right? Why this could happen, but why the investor perceive that differently? This is results from some empirical research. Some of you may do research in the future, so those would be some interesting topics to explore. Okay, a quick quiz. Yeah. What the impact of equity, the bonus share, the bonus issue of share could have? Total equity decrease? No. One equity account increase, another equity account decrease by an equal amount? Absolutely, right? Just reslice the share, very good. Okay. Next. Sometimes we may have, we have the shares here. Sometimes people may do the share consolidation. Sometimes people may do share split. The share consolidation, just like if you have two shares, each of them is $1. Now I have them combined as one share, and each share is $2. And sometimes if I have one share, $2, and I may split them to two shares, so each share will be $1. You may say, why the people want to do that? One reason could be just like, do you know Warren Buffett's share? The company he invested, like Berkshire Hathaway. So they use this company to invest in a lot of other properties, other companies. Can you guess how much the share is for this company, Berkshire Hathaway? That's Warren Buffett's the main kind of parent company for all the other investment. Give me a guess. How much per share is? Guess? Random number? $10? $100? $1,000? 10? Today's price, $306,000 per share, which means you might be able to afford for getting a share. I'm not. I can't. Okay, 300,000 US dollars per share. Okay, isn't that crazy? Why don't they split it? Why they keep the share so expensive? Control? One of the reasons, they don't want to get the share to be a very small ones so that the poor people like me can purchase one share, right? They don't want that happen. So they want it to be consolidated. They don't distribute dividend. They just push the price higher, higher, and higher. Last year, it was around 200,000 US dollar. Now 300,000 US dollar. So poor people like me would not be able to afford one share. So they can always keep the control. Okay, it's so hard to transfer the share to others, right? They want to have a kind of the certain group of people holding that share. Okay, that's one of the reasons. For the splitting, yes, if they decide one day they really want poor people like me to purchase their share as well, they may split it. All right, that becomes cheaper than the liquidity of this share purchase will be higher. Okay, so sometimes you will have the share consolidation, sometimes you have the share splits. It doesn't change, again, the whole pie doesn't change, but it will change the volume of transaction, right? It will affect what kind of people can afford to buy the shares, all right? And this conversion needs to be governed by Constitution. Okay, reserves. Reserve will be just some generic term for the equity account. And retained earnings will be one of the very important equity account, which accumulates all the annual reports for profit or losses. So there are some main movements to the retained earnings. Like the first thing, how do we get retained earnings? When we have this year, we have net income, which is the profit. After tax, after dividends, or after tax, let's say just after tax, because dividend could be net profit, net income from your operation. Remained in this reserve account. Is that okay? So that's the retained earnings. And also, if dividend paid or declared, it will also change retained. So you may distribute dividend from your retained earnings, then dividend out, retained earnings decreased. All right? Or the transfer or to form some reserves. Or the change in accounting policy and assures, whenever it affects the equity account, the reserves, it will affect this retained earnings. All right? So we have learned some other reserve accounts as well, like the assets revaluation surplus, foreign currency. What other reserves we learned? Did we learn some reserve accounts today? Forfeited share reserve, right? The lapsed option reserve. So when your equity increased, they can have a specific account for the reserve, right? And that reserve contribute to part of your equity account, but they are not contributed equity. Contributed equity, just the share capital, okay? So you may have other reserve like foreign currency transaction, translation, financial instrument reserves. Those topics, I guess most of you accounting major will eventually have the advanced financial accounting. They are not necessarily more complicated than this course, but they are just some separate issue you don't normally deal through the normal operation. So you won't be scared. They are fun. So just some separate issues, so should be relatively okay. But we don't deal with those reserve accounts in our course. So the disclosure, you just have not much to discuss. Okay, the second part of the topic is the provision and contingent liability. So we talked about the equity, then we have the liability. And the liability we discussed in today is not a normal liability we discussed in your prerequisite course. It's some kind of new concept, which is provision and contingent liability. Okay, so basically contingent liability is not really a liability. If that's the really liability, you should recognize it, right? But contingent liability, we don't recognize them. We only disclose in the notes. All right, that's contingent liability. Provision is one kind of liability. Okay, but why we have the provision specifically discussed? The normal liability you have learned. Request you to know how do I do the measurement and the specific, very specific thing. What I require you to know is just the concept of provision and how it will be distinguished from other liability. And the concept of contingent liability and how it is distinguished from other liability. And when a provision should be recognized. So the basic understanding of the two things would be enough for this course. So first of all, we want to see what is a liability, because like I said, provision is one kind of liability. So it means the concept of liability. What is a liability? You must know better than me, right? Because I haven't learned the prerequisite course you have learned, right? So the liability means the three elements of the definition. So one is it should be a present obligation. It arises from the past event and is expected to result in an outflow of economic resources. If there is no outflow of economic resources, that's not a liability, okay? And it should be your present obligation. It arises from the past events. So that are the three elements of the liability, right? Provision should have those three elements, but it's slightly different. I mean, have some additional things. You identify it as provision. Normally, this will give you the liability. And this one has something slightly additional, which is the uncertainty. Provision is liability, but it is a liability of some uncertainty. Uncertainty in two things, timing or amount. So you might be confused. So it has uncertainty. What do you mean by timing or amount? A provision is a liability, but the good example, I should have my clicker with me. A good example for this provision would be just like the warranty. I'll give you an example like the warranty. What is warranty? So, can you give me an account for liability, a normal liability? Account payable, a typical. When you sell something, you have credit sale. When you have that credit sale, you specify, okay, within next 3 months, you pay back 1 installment, 2 installment, and I will give you discount or not. Okay, that is the account payable. So there is nothing uncertainty in the timing, in the amount. Okay, that's all good. You may say, okay, how about the bad debt? It happens. Then my account receivable. No, that would be the assets. Okay, account payable. Okay, you mean, how about if I go bankruptcy? Then basically I will not afford that much of money. All right, in that case, it doesn't meet our assumption. Going concern. Okay, so we don't care. All right, anyway, the account payable, that's certain. Regarding timing, you know when you need to pay. Regarding the amount, you know how much you need to pay, right? However, another type of liability, let's say the warranty. The warranty is different. We sell products. Based on the past experience, we all know every year part of my products sold will get problems of repairment, replacement, or maintenance. All right, those kind of things I recognize as the warranty expense, right? However, I don't know which product will happen. But I can only estimate maybe 4% of the revenue will be treated as the warranty expense. I may spend 4% of the revenue to do the maintenance. All right, that would be good. Then, yes, I don't know when it's going to happen, to which product, and how much for each product. Okay, I don't know. But my estimation will show me, okay, I'm going to have the liability, but I just don't know the exact time, exact amount, but I can estimate it. Based on my experience, that's estimatable. Is that okay? So in this case, it's a liability, but there is uncertainty in timing and amount. And most likely, I will have this liability, and that amount can be estimated. Okay, so that will be the provision. All right, and typical provisions will be including them. Employee benefits are not provisions because that will be having a separate standards regulating that. Onerous contracts, do you have a concept of what is that? So basically just the concept, a contract. If you maintain the change from having what kind of contract that would be, why I should maintain such a contract. Just simply recall what you learned for lease. For the lease contract, if you sign for 5 years or 6 years, but by the 4th of years you finish your product line, but you still need to pay for the rent, right? Because you signed the contract for 6 years. And if you cancel, the cancellation fee is just ridiculous. So by maintaining this lease contract, your future economic outflow will be higher than the benefits. Then that's kind of an onerous contract. So this one you also recognize as the provision. All right. For contingent liability could be meeting similar things like the liability. It should be a present obligation, but it fails the recognition criteria. Or it might be an obligation which is actually not coming from your past events. It might be based on somebody else. Like if you have the loan guaranteed to pay back by you for another company. So it really depends on the other company's condition. If they go bankrupt, so you have to pay. But if they run well, you don't need to pay. Okay? So this also gives you the contingent liability. It doesn't meet the liabilities concept because it's not coming from your past events, and so it doesn't necessarily have this economic outflow, but the chance is there. It might happen. Okay, so you may just disclose. We don't say recognize contingent liability. We only say disclose because recognize means you got to measure that. That should be in your statement. This one is not in your statement. It only is disclosed in notes. All right. And if that's a present obligation, but it may not meet the liabilities criteria, then we may disclose it as a contingent liability. What do we mean it doesn't meet the criteria? It is not probable an outflow of resources will be required to settle the obligation. What do we mean probable? So there are some words to describe the possibility. If it's highly likely, that's probable. If the possibility, the profitability might be less than 50%, that's possible. Remote likelihood, more than remote, if the not probable will be just the between possible and not more than remote, not more than remote. Okay, not more than remote. So it could happen, but the chance isn't that high. Maybe 40%, 45%. Okay, so what do we mean more than remote? The likelihood is more than remote. We can't just simply think about Canberra. In the past 100 years, we never experienced earthquake. So the chance to happen is more than remote. But could that ever happen? Who knows? Maybe, right? So that is the likelihood of more than remote. Okay? So in that case, you wouldn't disclose it as contingent liability because the possibility is just too low to recognize, to disclose. All right? But if it's not more than remote, but just slightly less than the probable, it's not that high likelihood of happen, then you need to disclose. All right? So you say, how can I know that's 40%, 50%, 60%? Your judgment. It's subject to your discretion. Okay? So you see, accounting also created a lot of things. It's not just all the things you can follow the standards. All right? So, yes, the criteria of recognized provision just including the following things. So first, it is the present obligation as a result of past events, and it's probable you will have the outflow of resources. And the account, I did mention the provision different from the other liability in terms of the uncertainty. It could be uncertain in timing and amount, but you still would be able to reliably measure that. If you have no way to reliably measure that, you may just disclose it as a contingent liability. You must be able to reliably measure that. Like the warranty I mentioned, you know from the past experience 4%, 5%, or 2% is always about the guarantee, the warranty. Okay? So you must have a way to reliably estimate, measure it, otherwise you can't recognize it as a probation. Okay? Okay, here is a decision tree. So we start here. Here what we do, we are deciding whether that is the probation or that is the contingent liability. Or that's actually nothing. We don't do anything. Okay? So here flow of economic benefit is probable, the likelihood is high, and I can reliably measure that. What is that? We recognize it. This present obligation is also coming from past events, but I'm not sure how probable that is. The likelihood is not probable, and also the measurement is not reliable. Either of them. If you give the answer as no, then most likely, if that's no, then we most likely, we also estimate the likelihood. If the likelihood is more than remote, we will identify it as contingent liability. If we have some events, some present obligation arises as a result of past events, or it's not coming from the past events, or it might be unclear. Like I mentioned, there is another case, right? Maybe based on the others condition, right? There are two conditions, two situations you can make judgment on the contingent liability. If it's another condition, it's unclear whether that's coming from the past events, then most likely that goes to the contingent liability tree, right? Then, except for that, we need to see whether that's possible. Liability exists. Whether this one is higher, the likelihood is higher than remote, then we decide whether that is a contingent liability. If nothing like that, neither a provision or a contingent liability exists, we just do nothing. All right, so that is just the, you can use the previous information to match this decision tree. I think the best you go back to the understanding, then match your understanding with this tree. That would be better. Okay, that's for today. All the best lucks with you for all your exams, okay? See you after break. Again, the lecture 7, yeah, I guess you will not be able to attend. I will make a recording. Is that okay? Yeah. All right. Thanks. See you.